Why specifically have these stocks come out on top?
In two words, Fed policy. It really is all about large-scale asset purchases. As an old credit person, Steph, you could appreciate that what's happened in the fixed income market so far this year. Through the first quarter, 10-year yields were up 10 basis points. The yield on the investment grade, Barclays investment grade credit index rose 7, but the yield on the high yield index dropped 60 basis points. The equity risk premium of the defensive sectors, that is their earnings yield, less that real 10-year Treasury yield, has also dropped 60 basis points. So the part of Fed policy that's intended to drive money out of risk-free assets into riskier assets is surely working in the part of the stock market that looks most like the bond market.
But then why aren't we seeing more of this great rotation? Your argument holds true, and it does make sense to buy equities, in these same companies that we're seeing in the corporate and high yield market, but we're really not seeing that many investors put their money to work. Are they simply scared to be back in the stock market?
Well, ultimately, when you talk about things like money shifting from fixed income into equities, we don't really think that can occur. We don't really think you can get a sustainable uptrend in PE multiples or downtrend in the earnings yield until the Fed starts to normalize policy, until, stock prices are truly driven by improving growth expectations, not by Fed policy itself. So to us, it makes perfect sense that the parts of the stock market most sensitive to growth, namely the cyclical sectors, are struggling, while the parts of the stock market that look most like the bond market are performing well in this Fed policy environment. Now, if we could get to the other side where the Fed starts normalizing policy, that would be an environment where cyclicals should really start to outperform. But that, again, continues to be an if when you consider things like last Friday's payroll report.
Yeah, and of course, Barry, that begs the other question, which actually comes first, the tail or the dog, right? Is it the Fed that is able to raise rates because there's growth, or is it the other way around, and the growth comes after the fact that the Fed has kept rates low? I mean, which is it, right? Or where are we on the curve? Well,
at this point, it's not really about the latter. The Fed hasn't really been able to change the growth trajectory all that much. We've been at less than 4% nominal GDP since 2010. So I think this is more a function of just working our way through it and finally getting to the point where, yes, we have gotten to, we've removed some of those structural impediments in the housing market. We've gotten enough of the debt paid down. We've stabilized public policy that we start to grow. The Fed acknowledges that, in essence, they're being reactive to the improving growth environment. And then once the market adjusts to a change in Fed policy, there's invariably a correction, right? 2004, 94, when they make that first move, the market worries that that's all there was. Sort of the emperor has no clothes. But on the other side of that, stocks have performed extremely well, 1995 being a great case in point. Right? It was Armageddon in the bond market in 94, and the stock market went down 9%, and then in 95 it went up 37%. So,
Barry, as we head east from the Fed and look at the BOJ and their whatever it takes announcement last week, do you predict a massive rally in Japanese equities?
Well, they've had a massive rally, to be sure, and I would think that Japanese equities are probably getting expensive. It'll probably continue for some time, and it'll undoubtedly look like it does in the U.S., where, if they're successful in getting the pension system, the banks, the postal system to sell some of their JGBs and buy some other assets, we suspect they'll start by buying things like Japanese REITs, right? And the same thing, BOJ is actually buying some of those as well. But it'll probably drive that parts of the Japanese market higher. The other interesting question around that, Steph, is does some of that money wind up in the U.S.? Because ultimately, to get the yen to continue to stay under pressure at where it is now or go even lower, those same institutions have to not only sell JGBs, they have to buy some treasuries, or they have to buy some foreign-denominated assets. And so this could potentially exacerbate that whole large-scale purchase effect in the U.S., which, look, from a short-term perspective, it might boost bond prices in the parts of the stock market that look most like the bond market a bit. But in the long run, this is just throwing so much money at the problem. When you distort the interest rate relative to where it really should be, it's going to result in, price inflation, consumer price inflation, asset inflation, or just impair the whole creative destruction process.
Well, what you're really getting at, Barry, as I listen to you, is gaming the system globally. I mean, that's what it really boils down to. And look no further than what's happening at the banks, right, where loans as a percentage of total assets in decline, and that's part of the problem. There's not enough fundamental growth. The Fed, the Bank of Japan, the ECB, et cetera, they can only do so much. Isn't that really what it all boils down to, Barry?
No, that's right. I mean, people were very optimistic about banks for 2013, notwithstanding the outstanding performance in 2012. And for us, you actually have to get some asset growth now because it's not about releasing reserves anymore. Bank asset growth in the first quarter has been negative, and in particular in the real estate sector, because remember, housing's what got everyone all bulled up on banks. That's been still falling. There's still some real structural impediments. Fannie Mae, Freddie Mac, the FHA are mispricing mortgage credit. You still have reps and warranties liability problems. You still haven't told banks what their capital requirements are on mortgages. So there's just a range of structural problems there that really are the necessary condition to getting bank asset growth to go positive in those stocks to really perform over a longer period of time.